Hello, thank you all for joining us. I am Ann Johans. I'm a Extension Program Specialist with Iowa State University. And with me today, we have Beth Graybow with the Veterans in Agriculture and Patrick Hadding, who is an Iowa State University Extension Farm Management Specialist. I know Beth's going to share a little bit more detail about that. I am just going to share, if you have not joined us for a WebEx before, with Ag Decision Maker, we've been doing these the last few months. If you are new, thank you so much for being here. Along the right-hand side of your screen, you have access to a chat panel and a Q&A panel, and they kind of work the same in that those messages go to us. You cannot see the other attendees. You don't have to worry about your microphone, your camera. Those don't need to be working, which hopefully your speakers are, and you can hear us just fine today. But as we go through the presentation, type any and all questions into those, and we will, if you're having trouble or you have questions about the logistics of how WebEx works, we can get to those. Otherwise, if they are questions for the presenters, we will save all those for the very end. I'm going to turn my camera off and I'll come back and give those questions to them at the end of the presentations. And so with that, I'm going to turn it over to Beth, and she's going to share a little bit more about the session today.
Hi, welcome for coming and joining us on this WebEx. This is a new format for us. We appreciate that you are joining us today. As I said, my name is Beth Graybaugh. I'm with Veterans in Agriculture, and our organization is a nonprofit that is based in Urbandale, and our focus is to help veterans thrive in agriculture. So we really work to connect veterans and active military with the resources and information that they need, whether it be for production agriculture or to connect them with an ag job with agribusiness. So we'd like to thank Iowa State University for providing support for this series. And this project is also supported by the North Central Extension Risk Management Education and also USDA. So today we're going to begin this series, and we have Patrick Hadding, as Ann mentioned, is an Iowa State Farm Management Specialist. He specializes in farm programs, ag marketing, crop insurance, risk management, estate planning, and intergenerational transfers. So we appreciate him being a participant in this series. So Patrick.
All right, well, welcome. We'll get set up here. Welcome to the...
So Patrick, sorry
Yep.
to jump in. I am still seeing the PowerPoint program and not the slideshow.
Okay, I've got to figure out how to get this to move to the other screen. And I'm going to need your help very quickly. How do I get back to... I'm going to have to move to the other screen here. Let's go share. How about now?
I'm still seeing the PowerPoint program.
This is my slide right here. I think that this is not showing.
So I just see PowerPoint. So if you wanted to go ahead and share the file, I don't know if you want to try that again. We'll get there, folks.
Sorry about this. New system for me today. It's on me, my bad.
There, I see. Yep, that looks good.
Okay, well, you can see it. Well, welcome. I'm Patrick Hadding, and thank you for being on the webinar today. Our topic is, I'm going to talk about the Farm Bill, and then my friend and very experienced crop insurance agent, Lacey Schaefer, will take over the second half of the presentation today. A little bit of additional background about myself that Beth didn't include. I'm actually spent some time in other careers prior to joining Iowa State University. I had been working for the past 2 years in Southwest Iowa as the farm management specialist there. And in January, I was reassigned to the Central Iowa Territory. So it's been great. Iowa State's a great place to work, and certainly glad to be here. So in terms of the Farm Bill programs, really this is what these things are designed to do, all right? I think sometimes farmers think that, you know, this is the program that is going to, you know, provide large amounts of revenue, et cetera. And the bottom line is it's really just a safety net for most American farms. And so the two primary programs are the agricultural risk coverage and the price loss coverage. These decisions, they're very quickly approaching. That's why we thought today's webinar would be a great idea to emphasize the Farm Bill programs and to talk about them a little bit more in depth. I think that most farmers have decided, and I think that the numbers from the FSA office is maybe 50% of the folks have signed up. So the takeaway that I want to leave you with, and I'll have a slide that'll say this, but the takeaway is if you're making a Farm Bill decision on the price loss coverage or the agricultural risk coverage, you need to do that by the end of this week with the Farm Service Agency. But this is what I'm going to talk about right here this morning, and or I guess it's afternoon already. And so here's the decision variables. So the PLC is only triggered by low prices, and those benchmark prices are $3.70 on corn and $8.40 on soybeans. And the agricultural risk coverage county-based decision is triggered by low crop revenue in the county. And the agricultural risk coverage individual is triggered by the specific operator's farm revenue across all crops in the county, and then enrolled in the ARC IC program across the state. And what you would need to do is, once you have the decision that you think you want to make, my recommendation, again, make it this week. You still could change it before March 15th, because the second part of this equation, and Lacey's going to talk about this, is to add an endorsement product onto the PLC, if that's your choice, or the ARC County to add an endorsement onto that. So if you chose ARC County, you can actually you could add the ECO product. If you choose the PLC program, you could actually have the SCO and the ECO programs. All right. And I had talked to this morning at breakfast a producer that his choice was actually going to be the price loss coverage. And he takes it at the 70% revenue rate, and then he uses the SCO to get him up to 86%. So there's strategies and different ways people look at it, measuring their cost and what the potential benefits are. So the couple things I want to point out quickly about the Ag Decision Maker. We redesigned this so that you could read it on your smartphone. We have the Farm Bill information, and then some information that might help someone at least have an outlook would be Chad Hart's latest ag market outlook. And these will be updated as the WASDE report comes out about the 10th of each month. So it's not very long this month because there were not a lot of changes from January. So
Patrick,
yep.
is the screen, have you moved your slides?
Yes.
Because I'm locked on the first one.
Oh no. Suppose that's what you want me to do.
I see things. It's wonderful. We are good. And since I've already interrupted you once, I'll just point out to everyone that I have put a link to your slides in the chat box. If they want to download those, they are more than welcome to.
All right, so this is where we were right here. So you get to this point on the Ag Decision Maker website, you get to the information. It actually says the 2018 Farm Bill, because even though you're making a decision now, it's not the 2021 Farm Bill, it's the 2021 Farm Bill decision. So you click on the 2018 Farm Bill, and then what that does is it opens up a file, and when that file opens up, you hit open on it, and when that comes up, you'll see a button at the top that says enable, and you have to hit enable in order to make the program work. And once that program opens, it would open up to something like this. So I chose Boone County because it's a county that's within the territory that I work. And I put in a couple of numbers. So one of the things you're going to have to decide is, what do you think that the average price will be in the marketing year of the 2021 crop? And the marketing year starts September 1st of 2021 and goes to August 31st of 2022. Now, here's the science that I used to come up with the number 412. I took the futures price and I basically went 25 under to get to 412. So the futures price would be 437. That's going out to August of 2022. So that's how I chose to come up with a number. Someone would have to come up with their own number. The bottom line is you gotta understand that that number is going to change. I mean, I will be stunned if it turns out to be 412. It probably could be higher. It's going to be probably higher or lower. So, but doing the agriculture risk coverage, we're showing in here for Boone County what the yields were for the county yields for 2015 through 2019. And we don't have the 2020 numbers in there. And that is calculating on the Olympic average. And where I got the 202.8 is RMA has already done some projected yields. So I said, okay, we'll just put in 202.8 bushels. Well, that's not going to trigger an ARC County payment. And the reason that that is not going to trigger a payment is that that 202 is more than 162.9. And on, I'm not going to go over it on this webinar, but on the Iowa State webpage, you can go at the bottom to what's called the sensitivity analysis, and then you can see the correlation between as the price increases, the bushels would drop and vice versa. So that's on there for you. All right, so there's where I got that corn futures from. So I just took 25 cents off that 437 number to come up with the 412. That's my science behind that. And so in terms of looking at the, how do you come up with the price loss coverage number? So the first thing I want to point out in the middle of the screen, it says 153. So where does that come? That comes from the Farm Service Agency for off of what's called the 156 EZ form. And that would have your base acres and it would show what your PLC yield is. So that's where that plug number comes from. The 412 was from what we talked about on the first screen. And on the website, what you would be looking at is this would be just below the agricultural risk coverage calculator. So what this is saying, it'll say it till we're blue in the face. 412 is more than 370 for the marketing year 21, 22. So no payment would be there. If this 412 was not 412 and it was, say, 365, it would show a number down here on the bottom in the gray box where it says no payment. All right, and then I said, well, what about the soybeans? Where'd you come up with the $11.11? Same thing, looked at the futures price out to August of 2022. I took off a quarter. That's where I got 11.11 from. And then I put in the projected yield from RMA, which was 55. And again, no payment. You're kind of getting what's going on here. We're not expecting payments. And this would be where the futures price slide that I used, and that was from the WASDE report in or around February the 10th. And for the PLC on the soybeans, the projected yield in Boone County is 41 bushels. And so no payment is expected on the ARC County program. If you're seeing a theme here, we're just getting you ready because of the higher commodity prices. And if we have great production, there's not going to be any kind of an ARC County payment that's made or a PLC payment. All right, so these farm bill decisions, they're due by March 15th. Again, deciding, do you want the price loss coverage, the agricultural risk coverage county-based, or the agricultural risk individual? My experience had been in Southwest Iowa on the 2019-2020 decision on those crop years. Some folks already knew that they should be choosing ARC County because they had prevent plant acres, so they were just going to accept that and then deal with it on their own in 2020. Only 2% of the producers in Iowa chose the ARC individual in the 2019-2020 decision. So I don't see a lot of people choosing it. If you are, you probably have a unique decision that you discussed with your crop insurance agent. So this week, what do? You get that farm bill decision made with the Farm Service Agency. Get it done. What do you do next week? You're going to meet with your crop insurance agent. Then you're going to decide on these endorsement products, the SCO or the ECO coverage. All right, so I think we're getting ready for I'll show you the quick slide. These are my associates across the state. Should you have any questions, if you contact your local extension office, say you want to talk to the farm management specialist, they'll refer you to the farm management specialist for your area. And let's bring up the polling question. So we're interested to find out from you, what do you want to do next year in terms of your decision on the farm bill decision? Are you going to choose ARC County on both soybeans and corn? Are you doing ARC County on soybeans and PLC on corn? And so what do you want to do? All right. So we got a couple of minutes here, I think, before that closes. And if you think you have all the responses, you could force that poll closed.
Yes, I'm going to go ahead and give Lacey, I'm passing the ball now, right?
Yes.
Okay, so as that's going to close here shortly. So I'm going to give Lacey control, and while folks are doing that, then she can get her slide set up there, and I'm going to close the poll.
I'm going to introduce Lacey quick. So Lacey is an insurance services officer from Farm Credit Services of America in Red Oak. And Lacey has worked in the crop insurance and financial industry for over 18 years. She's a trusted advisor for many farmers. She specializes in precision technology and educating her customers to utilize their crop insurance to capture market opportunities, manage their risk, and position them for growth. And I would say she's an expert in selling your crop forward. Lacey, the ball is in your court.
And I did put the results, they can see those over on the right-hand side. We're about 2/3 on Ark County on both corn and soybeans.
Okay, great. Thank you, Ann.
Yes.
I think you have to unmute there.
We were seeing the presentation, Lacey. It was working good, but you are still muted.
It should be at the bottom.
We'll get there.
And I
Oh,
think
there we go.
all right.
I think you can hear me now. Sorry about that.
Okay, Lacey, the floor is yours.
Okay, so everybody can hear me and see me. My screen's correct.
Yes, it looks good.
Okay, perfect. So again, my name is Lacey Schaefer. I've been in crop insurance since 2008, and it seems like the only thing that doesn't change with crop insurance is it always changes. So it's a good thing, and we get to make a farm bill decision every year, and it marries up perfectly with our crop insurance these days. So I'm going to go over that, and I have, I think a little bit differently. So I may challenge a little bit on the Ark County decision. So why crop insurance? Nothing else in farming guarantees you revenue like your crop insurance does. There's two parts with revenue protection. You get guaranteed minimum crop insurance revenue, and you get minimum guaranteed bushels to forward contracts. So you can really hit some of those opportunities to get ahead of your cost of production and help you remain profitable and sustainable. So there's two products that we really kind of write at Farm Credit Services of America. One is yield protection, and I'm going to be quite honest, we do not have any products out of our office. Anybody that takes yield protection, 100% out of Red Oak, Iowa takes revenue protection. So if you wanted yield protection, that's simply what your average yield is, and then you pick your coverage level. Whereas revenue protection, you have your average APH, your average production history times your coverage level, and then you get a spring and a fall price. So like I said, with revenue protection, we are right now averaging that projected spring price. It's going to be the February average of December corn and November beans. Then we go through the growing season into harvest, and we see what the fall price is. So for corn, that's the October average of that same December futures contract. And then for beans, it's going to be the October average of the November futures contract. So with revenue protection, you have a spring calculation. So this is what you should be working with your agent on right now is seeing what your revenue guarantee is, picking your coverage levels so you can at least cover for the first time in a while your cost of production. And in some cases, you can even cover some a little bit of profit. So it's a really good time in crop insurance. So how you figure that is going to be your approved yield. times whatever coverage level you pick. That's going to be your bushel guarantee. That's going to be your minimum bushel guarantee. That's what you can forward contract and feel safe. And then you're going to take that times the spring price, and that's going to give you a revenue guarantee. Then, like I said, we go through the growing season and in the fall, use that same approved yield times your coverage level, still that bushel guarantee. But now with revenue protection, as long as you don't exclude it, you get the higher of the spring or the fall price, and that could equate to a new revenue guarantee being calculated. Then what you would do to calculate to see if you had an indemnity or not is you would use the highest one of those two guarantees, and you would subtract off whatever you harvest, and always times the fall price, and that's going to be your indemnity. Now, if you can get that formula, that algebraic formula correct in your mind, that's all crop insurance is. But you have to always remember that you're going to use that fall price to figure out what your revenue to count is, which is your fall price times your harvested production. So this year we have a new option. It's called ECO, Enhanced Coverage Option. We've had SCO, Supplemental Coverage Option, in the past. It hasn't been widely used because we've been typically taking Ark County on our beans, at least. So we haven't used it as much as we have really in the last couple years. We used it a lot last year on the corn, but probably looks more at Ark County on the beans. But every year is going to be a new decision. So I'll have a lot of the people I work with really look hard at this SCO. They are options that provide you additional coverage for a portion of your underlying deductible. So your deductible is basically whatever your crop value is minus what your insurance covers you. So you may have 75% coverage, so 25% of that's going to be your deductible. SCO begins to pay when county average revenue falls below 86% of what is expected. ECO is going to trigger at 95% or at 90% if that's what you take. There's two available options for ECO, 95 and 90. It is only going to be determined by the county average revenue or yield. It has nothing to do with your underlying policy. SCO always starts coverage at 86% and stops whatever coverage level you have on your underlying revenue protection policies. So if you have 75%, it's going to take you up to 86%. So it's going to give you 11% coverage on your SCO. ECO covers from that SCO limit of 86 up to 90 or 95% of that county. To be eligible for SCO, you cannot be enrolled in ARC program at FSA. So I could spend hours on this, not hours, well, yeah, probably hours, explaining why you should look at SCO and ECO, but Patrick only gave me 20 minutes, so I'll try to do my best. But why you should especially look at ECO over ARC County is that ECO and SCO are going to use the higher of the projected price. That's the February average. And you get the higher of the harvest price as well. With ARC County, you get the Olympic average prices, which is what Patrick went over. That's $8.95 and $3.51 on corn and beans. What SCO will give you is somewhere north of $4.50. We're not really sure yet because the price hasn't ended. Right now it's $4.55 and $11.76 on beans. So your guarantee on both ARC and SCO is going to be 86% of that county revenue. But with SCO, you're going to get the higher spring price when figuring out your guarantee. So the county guarantee is so much higher than it is with ARC County. But I believe the likelihood of either PLC or ARC County paying for 2021 is really slim because we're so far ahead of those reference prices and are marketing your average price, just like Patrick went over. Now, the disadvantage with SCO is that you do have to pay for it, but it is subsidized. On revenue protection, SCO is subsidized at 65%, whereas ECO is subsidized at 44%. Like I said prior, SCO is a way better safety net over ARC County because
of the spring price. But not only that, but SCO is going to pay on your planted acres. Now, I've looked at a lot of 156 forms, which show your base acres at the FSA office. And I'm going to suggest that on average, base acres to actual planted acres run about 52% of base to planted. So most people's bean base is going to be short. So if you look at SCO on nothing other than beans, it's still really good coverage on your beans. So let's take a scenario maybe of 100 base acres and 200 planted acres. SCO is going to pay on the 200 acres, whereas Ark County is going to pay on 85% of the 100 acres. So you're only going to get paid on 85 acres on your Ark County. So you have to really look at it. Is it a really good safety net? In some cases, it's going to make sense for you to even take a step back. Say you're 85%, you could step back to 80% or even 75% and stack SCO on top of it. And you're not going to spend, in some cases, you're going to spend less premium by doing that. And then you can use those premium savings to even add on hail insurance. So you're really, really covered. You're covered up to 86%. You have hail insurance, you got county-based coverage, you have your underlying multi-peril coverage. So that would equate to some really strong coverage for 2021, if that's a situation that would be good for you. In that case, you would want to be correlated with the county, meaning you want to be raising with the county. You can be above it, below it, but you just want to be highly correlated with the county. So like I said before, these are subsidy rates on your crop insurance. So that 75% is highly subsidized. And then you stack on an ECO or an SCO at 65%. And then you can also look at tacking on an ECO above that as well, up to 90 or 95%. This is just a brief visual of looking at different coverage options. That top orange bar is going to be ECO. The blue bar is going to be your band of coverage on SCO, and then the green bar is going to be on your underlying revenue coverage. So in this situation, you could look at going from an 80% policy, which would cost you $10.39 if you had straight 80, not looking at those top two coverages. You could look at taking it down to a 75 and adding SCO for $11, a little over $12 an acre. So you're not spending much more premium, but now you have 86% coverage. So that's what some of our producers that we work with have been looking at doing. Some will even take the money and spend a little bit extra on the ECO to cover up some of that price this year as well. This is just a quick calculator. I have a couple calculators in here to kind of go over a scenario. So this is Adair County. This is one of the counties I work with. We're going to say that the producer and the county has the exact same yield of 54.3, and we're going to say that they harvest together a 45. The projected price and the harvest price remains the same. So we're talking about a 9.3 bushel loss. And in that case, RP, the one on the top left, would not pay anything on the crop insurance, okay? It would actually be a net indemnity, so you pay out more of your crop insurance than what you would collect, $4.04. SCO, on the other hand, would generate a payment of $12.84 because that insured has up to 86% coverage. If this insured had taken RP, SCO, and ECO, that bottom left-hand box, that would generate a net indemnity of $49.67. So that's just a scenario where looking at different coverage options, how maybe your underlying revenue protection wouldn't pay in the past, and why it's a good idea to look at some higher level SCO coverage to really get your cost of production covered. That's a good way to add on a little bit of coverage and really cover that cost of production if we can get it done this year. This is using that same scenario. So a harvest yield of 45 and the projected price and the harvest price of 11.77. So this is what Patrick was showing earlier, where the county looks at the last 5 years and uses an Olympic average of that yield times the Olympic average price times 86% would give this county $432 of ARC county coverage. In this scenario, at that 45 bushel, the same 1177 price, that would give county revenue of $529. So ARC will not pay. 1177 is far above PLC at 840. So PLC is not going to pay. So I agree with Patrick 100% when I say that when we say that the chance of either underlying risk management plan through our FSA offices, it's slim that those would ever pay. That yield is going to have to get really low for that ARC county to pay. And if that yield is low, typically that equates to higher prices. So that county revenue is going to continue to grow. So I am a firm believer is I know SCO costs some, extra premium, but the amount of coverage that you can obtain from that and the point of SCO starting to pay based on your base acres and based on that higher spring price, it provides a lot of value to producers right now. Okay, so this is our second polling question here. So knowing what you know, and I don't know if I've helped or not, but what do you plan to do with your crop insurance? Is that going to be A, increase coverage, knowing the value of increased protection and marketable bushels? B, decrease your coverage because you just can't justify the increase in cost? Or C, keep the coverage levels and capture the increase in revenue guarantee?
And that poll is over on the right-hand side of their screens, and I see those answers are coming in, Lacey.
Okay.
Okay, I have the vast majority have responded, so I'm going to share those results. And I'm not sure, I'm not sure if you can see those, but
I can see them.
okay.
Perfect. So it looks like about 50% are going to keep the same coverage levels. And maybe about 33% are going to increase coverage levels. So I am in the camp of either one. I think that, like I said, SCO provides us some really good coverage just based on those spring prices and the coverage on the planted acres. So I would look hard at that. And if you want SCO, you do have to choose PLC. So like I said, I don't think either program's going to pay. So I'm a big proponent of SCO, which requires me to take PLC. So just a quick slide here on the VFR benefits. This was new a couple years ago. Talk to your agent and do the appropriate paperwork because you do not have to pay administration fees. You get this is a big one. You get an additional increase in premium by 10%. You can use your previous production history from another producer if you were involved in the decision making. And in the case of a hailstorm or something, a drought where there was low yield to ratio, normally you'd only get 60% of the county T yield. With VFR designated on your policy, you get 80%. So that's a big deal as well. So just in summary, premiums are going to be higher. They're going to be about a quarter to a third higher this year, just based on the volatility. I mean, we can't take beans 40 cents in one day and not expect the markets to be volatile, and volatility really drives crop insurance premiums. That's probably the biggest thing of why the premiums are increased, but also, we're getting a lot more coverage than what we had last year. We're getting $100 more at least on the corn and, $80 to $90 of coverage on the beans. So, we get to protect a lot of our cost of production, and we get, those bushels to go out and capture marketing opportunities when we can get ahead of our cost of production. So no, they're going to be higher, but, like I said, there's nothing else in farming that guarantees you revenue. So really take those decisions to heart. Consider all your options when choosing coverage to protect these valuable spring prices. And with revenue protection, you get the increase in the price in the fall too. And really, SCO is a really viable option. If you choose that, you have to choose PLC for your farm program. If you're not going to choose SCO, I'd probably consider Ark County on the soybean base, and either one, PLC or Ark County on the corn base. So look hard at SCO, have your agent quote it, because the value in the base acres versus planted acres and the value in that spring price versus your $8.95 guarantee on your Ark County marketing your average price, it's a big deal this year. So thank you for listening to me. I could go on forever, but I'm about to get the hook. So good luck with your crop insurance and your farm bill decisions. And I would actually go talk to your crop insurance agent and let that program drive what you choose at the FSA office. So if you can get to them sooner than later, I'd get her done.
Thank you, Lacey.
Yes.
This is the chance to send in some questions. I do have a couple. So you talked about those veteran benefits. I'm curious, you said those were only a couple years old. Have they changed, or is that new for the crop insurance side of things in general? And then are those specific to farm credit, or is that across the system?
That's across the system. Those are RMA rules, and they were new. I think this is the second or third year for VFR benefits. There's BFR, which is beginning farmer benefits as well. But yeah, VFR is, I think this is our third year. If I would have to go back and look, but they are not specific. Those are RMA rules. You do have to have applications in by March 15th though, so.
Which is when everything else is due, right? So
pretty much.
Then my other question, you mentioned down in that Southwest, I guess, do you cover the entire Southwest kind of region?
Pretty much the southwest corner of Iowa.
Okay.
I am not over towards the river. We have a team in Red Oak, so I go kind of towards the east, the south central, I guess, and then we have some that go along the river as well.
Because you mentioned that you don't have a lot of yield protection policies.
I do not.
What is the split kind of going into 2021 between, is mostly everything a revenue protection?
Mm-hmm. I would guess, I don't have the specific statistics in front of me, but I'm going to guess I would guess over 90% of acres in Iowa, maybe even closer to 93% are insured with revenue protection versus yield protection. There's just not enough cost savings to justify what you lose with revenue protection, especially we are all big proponents of marketable bushels, and it's really hard to make good marketing sound decisions without having a revenue protection policy to protect those bushels.
What interest are you getting kind of in that area for SEO? Are you getting a lot of questions?
Ton. I'll write probably, so I write about 120 policies of my own, and I would guess that I'll write 60 to 75 of those with SCO. Some will pick it up and put it on top. Some will step back in coverage and pick it up and put it on top. I would say ECO is probably more like 10%, but there will be some that take ECO. But yeah, I think SCO, we have a program at Farm Credit Services of America that we peg your yields with a county yield so we can see how highly correlated you are with a county. And then we can take that and overlay it with your APH and show you if 2012 happens again, how would SCO perform versus how would 75% enterprise units perform, or 80%? What's the biggest net return? And we can overlay that over 10 years. And that really puts, the data behind what we're saying so that you can choose the best policy given the situation that you think is going to happen this year. So I'm a big fan of SCO.
And SCO, you could trigger a payment on SCO, but not your underlying policy, correct?
Correct. Yes.
And so producers, that they could get one or the other or both, looking at 2021. When are those payments made under SCO and ECO?
Okay. I'm so glad you asked that. So all of the county data has to be in. These payments are generated off of RMA data. It used to be that they were off of NAS data, but now it is RMA data. The last day to turn in RMA yields, your crop insurance yields, isn't until April 29th of the following crop year. So we're not going to know if SCO triggers a payment until that late May, June timeframe of the following the crop year. If that's a deal breaker, you're not going to want to step back on your coverage level and pick up SCO if you have to have your money in the fall when you harvest that crop. Most people will use that as just kind of like their marketing plan. They market into the next crop year. They doesn't bother them. So, but they do have to understand that.
Yes, I think we've been told kind of middle of I don't know, maybe they'll figure out payments ahead of time, but like publicly released yields from RMA, the deadline is the middle of June. So if they get them released ahead of that, but we've been told the
Right.
middle of June.
Yep.
So producers wouldn't see an SCO payment for 2021 until June of 2022.
Yep.
And you aren't going to see an ARC or PLC payment until, if there would be one for 2021, Patrick, those payments wouldn't be realized until
October
there we go. Okay, very
of
good.
2022.
So there's a lot of delay in these safety nets and why, can you explain a little bit about why there's the delay in the ARC and PLC program?
It's all the calculations with that they're scrambling in the month of September to figure out what that average marketing year price was across the nation, because that marketing year price is in Iowa. It's everywhere across the country.
Yeah.
And
since
there's
that
a lot of numbers that have to be crunched.
Yeah,
and I'm
since
sure
that doesn't end until August, then we don't see those until October.
I'm sure Secretary Vilsack's staff is just busier than there's no tomorrow in the month of September crunching his numbers.
Very good. Give a chance to see if there's any other questions. I was going to see, Beth, do you have any that you wanted to bring up?
No, I appreciate our speakers today and all the information that they have been providing, but I don't have anything at this time.
Okay. And Patrick and Lacey, I'll let Patrick go first with it. Are there any comments that you wanted to share as we wrapped up today's session?
No, I actually, I learned something today on Lacey's presentation because I was not familiar with that VFR benefit. And I think we're going to do a better job at extension of making sure folks know that. And I would be curious to know, does someone just say, yes, I'm a veteran, or do they have to provide their DD Form 214, or do they have to verify it in any way?
Yeah, they are verified. You actually have to apply for those benefits, and then they have to be approved through the AIPs.
Okay.
So, Lacey, I think it's really important to have a good relationship with your crop insurance professional. How often would you recommend kind of touching base as a producer, or how often do you tend to touch base with your clients?
At least 3 times a year, and that's just it's more than that. If you have a claim, you got to know what your marketable bushels are, I think, and you have to know that right now or prior to right now. This is the most important time in crop insurance during the year. You're setting your coverages, you're getting your guarantees, you're knowing what your marketable bushels are, so that you can actively go out and execute your risk management plan. So right now, I believe, is the most important time. You need to spend some time understanding what your policy is and what it does for you. Then throughout the year, you're going to report your acres, you're going to do your production, you're going to report any claims. Those are more transactional, quick hitter things for the most part. But right now, I think is the most important time that you really need to spend some time with your agent. And that's what I expect out of my producers, because we're going to get nitty gritty and we're going to go through a lot of it so they know what they have. And then so they can tell me, if I'm not providing what they need to.
Yeah. When you get a new client, do you check to see if they're a veteran? Or is that something that maybe would just come out of a conversation getting to know them?
veteran or beginning farmer, we have checklists that we use so we can kind of, because with crop insurance, it's so much sometimes that you can miss things. So we try to go through checklists and things like that. And newsletters, we send out newsletters and that go over all those details too.
Very good. Thank you.
Yeah.
Now, Beth, can you share a little bit about what next week's webinar is?
So next week's webinar is going to cover the basics of grain marketing. So that's kind of a very large topic and it can be deep and involved, but we have a veteran who's going to speak on that program for that whole subject, and he's a grain company manager. So we hope to be able to, that people learn at least the basics, some of that information, those terms, so they can start to understand grain marketing a little bit better.
So with that, I don't see any other questions that have come in. Thank you both so much for joining us. I really appreciate that. I also learned it was good to hear from a crop insurance provider to get a little more insight on how you're kind of looking at that SCO, ECO balance coming into 2021. And just thank everyone for joining us. Beth will have the recording. This is recorded, and so she will take care of some follow-up information for those online. And then I know we had some requests for those who were asking about the recording, and so definitely get some more information out there on this. And so with that, we are going to close out today's session, and I hope to see you all again next Wednesday over lunch for our second in this series. Have a wonderful day.
You too. Thank you.
Thanks, Ann.
Thank you.
Thank you, Lacey.
You bet.